UK pension. Tax secrets, 3 legal strategies HMRC won't tell you about. Right now, as you're watching this, there's a very good chance you're handing HMRC more money than the law actually requires you to pay. Not because you've done anything wrong, not because you're bad with money, but simply because nobody told you the rules. And I don't mean loopholes or gray areas. I mean perfectly legal strategies written directly into UK tax law that millions of pensioners are completely unaware of. By the end of this video, you'll know exactly how to fix that. Let's start with something that might genuinely shock you. HMRC's own data suggests that billions of pounds in unclaimed tax relief and allowances go untouched every single year. The marriage allowance alone has over 2 million eligible couples who've never claimed it. 2 million couples, each one leaving up to 252 sitting on the table for absolutely no reason. And that's just one small piece of a much bigger puzzle. Here's the thing about the UK tax system that most people don't understand. It wasn't designed to automatically give you everything you're entitled to. It was designed for you to claim it yourself, which means if you don't know what you're owed, it simply doesn't come to you. The system isn't dishonest about this. It's just not particularly forthcoming either. And that gap between what pensioners are entitled to and what they actually claim costs ordinary people thousands of pounds every single year. So today we're going to close that gap. 3 strategies, all completely legal, all approved by HMRC, all used routinely by wealthy retirees and their financial advisors, and all available to you, starting right now. The first strategy is one that married pensioners especially need to hear, because if you're in a couple and you haven't thought about this, you could be overpaying tax by over £1,000 a year without realizing it. It's called income splitting, and it works because of one fundamental truth about the UK tax system. Every individual gets a personal allowance. For the 2025 to 2026 tax year, that's $12,570 of income that is completely tax-free. Every single person, which means a married couple living together has a combined tax-free allowance of $25,140. Now, that sounds great in theory, but here's where the problem starts. Most couples don't split their income evenly. In fact, the opposite is usually true. One partner, often the husband in older generations, has a substantial private pension on top of their state pension. The other partner might only receive the state pension, which currently sits at around $11,500 a year for those on the full new state pension. So one partner is paying tax on everything above their personal allowance, while the other has thousands of pounds of unused allowance just going to waste. Think about what that actually means in practice. Let's say David gets $24,000 a year in total pension income. His wife Sandra gets $2,500. David is paying basic rate tax of 20% on everything above $12,570. That's roughly $2,286 going straight to HMRC every year. Sandra, meanwhile, has over $2,000 of personal allowance she's not using. As a household, they're paying tax they don't need to pay, not because they're doing anything wrong, simply because of how their income is structured. So how do you fix it? The key is to look at where you can legitimately shift income toward the lower earning partner. You can't transfer your state pension. You can't hand over your defined benefit pension payments. But there are areas where you absolutely can make changes. Savings and investments are the most immediate opportunity. If you and your spouse have money in savings accounts, investments, or shares, and those assets are all held in the higher earner's name, then all the interest and dividends are landing on top of their income and getting taxed. But if you move those assets into the name of the lower earning partner, the same money generates tax-free income because it sits comfortably within their unused personal allowance. On David and Sandra's $50,000 in savings, earning 2.5% interest, that's $1,250 in interest per year. In David's name, he pays 20% tax on it. That's $250 gone. In Sandra's name, it's completely tax-free. One straightforward change, no complex paperwork, and that's $250 back in your pocket immediately. And if you scale that across all investments and savings, the numbers grow quickly. Then there's the marriage allowance itself, which is separate and worth knowing about. If one partner earns less than the personal allowance, so under $12,570, and the other partner is a basic rate taxpayer. The lower earner can transfer 10% of their personal allowance, that's 1 out of 260, to the higher earner. That reduces the higher earner's tax bill by $250 a year. And you can backdate it by up to 4 years, meaning some couples can claim over £1,000 in one go just by filling in a simple online form at gov.uk. It takes about 10 minutes. HMRC estimates over 2 million couples are eligible and haven't claimed it. If you think that might be you, stop everything after this video and do it today. That's free money, and it literally requires nothing more than a few clicks. But income splitting is just the beginning, because there's a whole second layer of tax efficiency that most pensioners haven't even considered, and it's about something you probably already have, but might not be using to its full potential. Let's talk about the tax-free wrappers and allowances that exist all around you, and why the order and timing of how you take income can make a massive difference to how much tax you pay. Most people think about income in a fairly passive way. Money comes in each month, tax gets deducted, life goes on. But here's what savvy financial planners understand that most people don't. For pensioners with flexible access to their pension savings, you have an extraordinary amount of control over your tax situation. The question is whether you're using it. Start with your ISA allowance. Every UK resident gets $20,000 per year that they can put into an ISA. Money inside an ISA grows completely free of tax. No income tax on interest, no capital gains tax on growth, no tax at all on withdrawals. It's one of the most generous tax shelters in the world, and a significant number of pensioners either don't use it or don't use it strategically. Here's why this matters so much in retirement specifically. Imagine a couple who both maximize their ISA contributions every year. That's $40,000 per year moving into tax-sheltered accounts. After 5 years, that's $200,000 sitting in ISAs. If that money earns 5% annually, that's $10,000 a year in completely tax-free income. If that same money were sitting in a regular investment account and both partners were basic rate taxpayers, they'd be handing over $2,000 a year in tax. Over a 20-year retirement, that's $40,000 saved from one relatively simple strategy. And that doesn't even account for compounding. Now let's talk about pension withdrawals, because this is where things get particularly interesting. If you have a defined contribution pension, a personal pension or a SIPP, you likely have something called flexible access or drawdown. This means you can choose how much you take out each year, rather than being locked into a fixed annuity payment. And that flexibility is incredibly powerful from a tax perspective. Many people, when they retire, take their full 25% tax-free lump sum all at once. Under current rules, you can take up to $268,275 completely tax-free. That sounds appealing. But depending on your income situation, it might not actually be the most efficient approach. There's an alternative strategy called phased withdrawals. Instead of crystallizing your entire pension at once, you crystallize small portions each year. Each time you do, 25% of that portion comes out tax-free and 75% is taxable. By doing this gradually over many years, you can drip feed your tax-free cash into your income while carefully managing how much taxable income you receive each year. Why does that matter? Because of something called threshold management. There are specific income levels in the UK tax system where the cost of earning one more pound becomes dramatically higher. The most significant one that most pensioners never hear about is the $100,000 threshold. Once your total income exceeds $100,000, you start losing your personal allowance. For every 2 pounds you earn over $100,000, you lose 1 pound of personal allowance. By the time you reach $125,140, your personal allowance is completely gone. What this creates is a band of income where the effective tax rate isn't 20% or even 40%, it's 60%. That is not a typo. 60 pence in every pound goes to HMRC on income between $100,000 and $125,140. If you have pension pots and investment income that could push you into that range, strategic timing of when you take that income isn't just helpful, it's potentially worth thousands of pounds a year. And there are smaller allowances worth stacking up too. The personal savings allowance gives basic rate taxpayers $1,000 in tax-free savings interest every year. Higher rate taxpayers get $500. The dividend allowance gives everyone $500 in tax-free dividend income annually. Neither of these is life-changing on its own, but organized correctly alongside your ISA strategy and income timing, you can ensure you're extracting significant amounts from your portfolio each year at zero tax. The key principle across all of this is simple. Know your thresholds, know your allowances, and make conscious decisions about where your income comes from and when. That kind of intentional approach is what separates pensioners who overpay tax from those who don't. But there's one more strategy to cover, and this one surprises almost everyone who hears it for the first time. Most people think pension contributions are something you do when you're working and building for the future, saving now, benefiting later. And once you're retired, that chapter is closed. It isn't. If you have any form of earned income, and that includes part-time work, self-employment, or in some cases, earnings from a furnished holiday let, you can continue making pension contributions and receiving full tax relief right up until the age of 75. And the financial logic behind doing this is genuinely remarkable. Here's how it works in practice. Let's say you're 67 years old, you've retired from your main career, but you work a couple of days a week earning $12,000 a year. You also have pension income of $18,000. Your total income is $30,000. You're paying basic rate tax on everything above your personal allowance. Now, suppose you take $3,000 of your earned income and put it into a pension. You don't actually pay $3,000. Because of basic rate tax relief at source, you only need to contribute $2,400. The pension provider then claims the other $600 directly from HMRC and adds it to your pot. Your pension has grown by $3,000. You've personally paid in $2,400, and your taxable income has dropped, saving you additional tax on top. That is an immediate 25% return before the money has even been invested. No stock market required, no risk, just the tax relief that the system is designed to provide. And if you're a higher rate taxpayer, it gets even better. Higher rate taxpayers get 40% relief on pension contributions. And if you're caught in that brutal 60% trap between $100,000 and $125,140, pension contributions can be one of the few legitimate ways to pull your income back below that threshold and escape the 60% effective rate. The return on contributions in that scenario is extraordinary. There's also a provision that many people find genuinely surprising. Even if you're not working at all, even if you have no earned income whatsoever, you can still contribute up to $2,880 per year into a pension and receive basic rate tax relief. That means your pension provider claims $720 from HMRC on your behalf, and your pension pot grows by $3,600, even though you only physically paid in $2,880. Non-working spouses can do this too, which means a couple where one partner isn't working can still be building pension savings and receiving tax relief every single year. It's a quiet but consistent way to grow wealth inside a tax-efficient wrapper. Now, there is one more advanced strategy worth mentioning here, though it comes with an important warning. It's called recycling tax-free cash, and you need to know about it so you can either use it correctly or avoid crossing a line you shouldn't cross. The legitimate version of this works like this. You take a tax-free lump sum from one of your pension arrangements. You use some of it for genuine living expenses, but you have surplus beyond what you actually need right now. That surplus can, in certain circumstances, be contributed into a different pension scheme, where you then receive tax relief on the contribution. You've essentially moved money through the tax-free system in a way that generates additional relief. However, HMRC has very clear anti-avoidance rules around this. If they determine that the primary purpose of your tax-free cash withdrawal was to recycle it back into a pension for the relief, you can face significant penalties. This strategy is only appropriate in specific circumstances and only with proper professional advice. Don't attempt it alone. So let's bring everything together, because you now have 3 powerful tools that most UK pensioners never use. First, income splitting and allowance optimization. If you're in a couple, look hard at how your income and assets are structured. Move savings and investments toward the lower earning partner. Check your eligibility for the marriage allowance right now. 2 million couples haven't claimed it. Make sure you're not one of them. Second, strategic use of tax-free wrappers and income timing. Maximize your ISA contributions every year. Understand the thresholds that trigger higher tax rates and plan your withdrawals to stay below them. If you have flexible pension access, use phased withdrawals to manage your taxable income year by year, rather than taking everything at once. Third, pension contributions for those with earned income. If you're still working in any capacity, contributing to a pension isn't just for the young. The immediate tax relief makes it one of the highest return, lowest risk financial moves available to you. And even if you're not working, the non-earner contribution allowance is still there to be used. Here's the most important thing I want you to take away from all of this. None of these strategies are complicated in principle. They're not loopholes that might disappear. They're not schemes that require expensive advice to set up. They are built into the fabric of the UK tax system precisely because Parliament decided these are legitimate ways for ordinary people to organize their finances more efficiently. Wealthy people use them. Large corporations use them. There is absolutely no reason you shouldn't too. What you do need to remember is that everyone's situation is different. Income levels, pension types, ages, family circumstances, all of these affect which strategies apply to you and how. Before making significant financial decisions based on what you've heard today, please speak to a qualified financial advisor or tax specialist. The cost of professional advice is often recovered many times over in the savings it helps you make. But don't let the complexity be an excuse for inaction. Start with the easy wins. Check your marriage allowance eligibility today. Review whose name your savings are in. Think about whether you're maximizing your ISA allowance this tax year. These aren't big, complicated moves. They're simple, practical steps that real people take and that genuinely make a meaningful difference. Your money has already been earned once. There's no good reason to hand more of it to HMRC than the law actually requires. If this video has been useful, please share it with someone you know who's retired or approaching retirement. These are conversations that don't happen enough, and the more people who understand how the system works, the better off everyone is. Subscribe if you want to keep seeing content like this, and leave a comment below if there's a specific pension or tax topic you'd like us to cover next. I'll see you in the next one.